Every time the world thinks, this time is different, the global economy collapses again, markets crash, banks fail, people lose jobs, savings disappear, and suddenly everyone is asking the same question we asked the last time. How did this happen again? But here's the uncomfortable truth most people never hear. These collapses are not accidents. They are not random, and they are not caused by just bad luck or one greedy corporation. They follow a hidden system that has repeated itself again and again for over 100 years. And once you see this system clearly, you can never unsee it. Before we go any further, if you want to truly understand how money, power, and global systems really work, make sure you like this video and subscribe to the channel. It helps Global Economy Decoded reach more people who want real explanations, not surface-level news headlines. Trust me, what we are about to uncover will completely change how you see every economic crisis from now on. Imagine this. You're standing in a crowded room. Everything looks calm. People are smiling, laughing, confident. But slowly, without anyone noticing, the floor beneath everyone's feet starts cracking. No alarms go off, no warnings on the walls. The cracks are invisible to most people. Then suddenly, the entire floor collapses. Chaos, panic, and everyone asks, why didn't we see this coming? The global economy works exactly like that room. Economic collapses always begin during times of extreme optimism. That's the first pattern. When people believe risk is gone, that's when danger is at its highest. In the late 1920s, Americans believed the stock market would rise forever. In the early 2000s, people believed housing prices could never fall. In 2020, investors believed central banks could print unlimited money without consequences. Different decades, different assets, same belief. Nothing can go wrong. Here's the hidden system at work. It always starts with easy money. Central banks lower interest rates, credit becomes cheap, and borrowing feels painless. Businesses borrow to expand. Governments borrow to spend. Consumers borrow to live lifestyles they couldn't afford before. At first, it feels like prosperity. Jobs increase. Markets rise. Confidence grows. This phase is often called growth, but it's actually debt-fueled illusion. As debt grows, asset prices rise faster than real productivity. Stocks rise not because companies are stronger, but because money is cheap. Houses rise not because people earn more, but because loans are easier. This creates bubbles, but bubbles are hard to see from the inside. When everyone around you is making money, doubt feels stupid. Caution feels old-fashioned. And that's exactly when the system locks people in. Banks play a crucial role here, but not in the way movies usually show. They don't just lend money, they create it. When banks issue loans, they expand the money supply. More loans mean more money chasing the same assets. Prices rise. This rewards early borrowers and punishes those who wait. Society slowly shifts from rewarding saving to rewarding risk-taking, and the longer this continues, the more fragile the system becomes. Now comes the part no one likes to talk about. Debt always grows faster than income. Always. At some point, borrowers can no longer service their loans. Defaults begin quietly. One sector struggles, then another. Banks tighten lending. Interest rates rise, sometimes intentionally, sometimes automatically. And suddenly the system that depended on constant borrowing starts to choke. This is where fear replaces optimism. Asset prices stop rising, then they fall. Leverage turns against investors. People who borrowed heavily are forced to sell. Selling pushes prices down further. This creates a chain reaction. What looked like wealth was actually debt, wearing a disguise. Every major collapse follows this exact cycle. The Great Depression, the Japanese asset bubble, the dot-com crash, the 2008 financial crisis. Different triggers, same structure, easy money, excess debt, overconfidence, then panic. But here's the deeper layer most people miss. These collapses are not just economic events. They are power-shifting events. When markets crash, those with liquidity and influence gain control. Assets move from weak hands to strong hands. Small investors panic and sell. Institutions wait, then buy at discounts. Wealth doesn't disappear. It changes ownership. This is why recovery always feels uneven. Markets bounce back faster than people's lives. Stock indices recover while wages stay flat. Housing prices recover while affordability collapses. The system is designed to protect capital before people. And this is not a conspiracy theory. It's a structural outcome of how modern finance is built. Governments respond with stimulus. Central banks print money. Interest rates drop again. The cycle restarts. Short-term pain is reduced, but long-term imbalances grow larger. Each rescue makes the next collapse bigger. Think about that. The solution to the last crisis becomes the fuel for the next one. At this point, you might be wondering, if this system keeps failing, why does it still exist? Because it benefits those who understand it early and control it from the top. The average person enters late, carries the risk, and exits in fear. Education systems don't teach this. News channels don't explain it. They focus on symptoms, not structure. That's why platforms like Global Economy Decoded exist, to break down what's really happening beneath the surface. Another critical pattern is memory loss. After every collapse, regulations increase, lessons are promised, and reforms are announced. Then a new generation enters the market. They didn't experience the last crash. They hear stories, but stories don't carry emotional weight. Risk slowly becomes attractive again. Leverage returns. History doesn't repeat because people are stupid. It repeats because incentives remain the same. Technology doesn't break this cycle. It accelerates it. Faster trading, instant loans, algorithmic decisions. Speed increases volatility. Confidence rises faster. Fear spreads quicker. Collapses happen faster. But they are still built the same way. Right now, many people believe they are living in a unique economic era. New tools, new policies, new systems. But underneath it all, the same foundation exists. Debt, leverage, speculation, and human psychology. Greed and fear never change. They just find new expressions. The real question is why most people never see the collapse coming, even when the signals are right in front of them. And the answer is uncomfortable but simple. The system doesn't reward awareness. It rewards participation. As long as people keep borrowing, spending, and investing, the machine keeps running. And the moment people slow down, the system starts breaking, which is why incentives are always aligned toward optimism, not caution. Before every major collapse, there are warning signs that repeat again and again. Debt levels quietly reach historic highs, asset prices detach from real income, and media narratives shift from "be careful" to "you're missing out." Anyone who questions the boom is labeled negative or outdated. And this social pressure is powerful because humans are wired to follow the crowd, especially when money is involved, allowing fear of missing out to become stronger than fear of losing everything. Another repeating sign is complexity, where financial products become harder to understand, whether it was mortgage-backed securities in 2008, junk bonds before that, or today's highly leveraged funds, derivatives, and opaque balance sheets. Because complexity creates distance, and when people don't understand something, they trust experts who are often rewarded for short-term performance rather than long-term stability, meaning that if the system collapses later, they've already collected bonuses and moved on. This is where the idea of too big to fail quietly enters the picture. As large institutions grow so interconnected that their failure threatens the entire system, forcing governments to step in during collapses, not to save ordinary people, but to prevent systemic breakdown, while bailouts are framed as protecting the economy. Even though benefits flow upward first, losses are socialized and gains remain private, not as a glitch, but as a feature of the structure itself. Ordinary people experience collapses very differently, losing jobs, homes, savings, and years of progress, while recovery feels slow and unfair because wages recover last, debt remains, and markets rebound quickly due to massive liquidity injections, creating a psychological disconnect where people are told the economy is strong while their personal reality feels weak, fueling frustration, distrust, and anger. Over time, this leads to another repeating outcome where each collapse increases inequality, allowing those who already own assets to gain more while those who rely on income fall further behind. Not because one group is smarter or works harder, but because the system is built around asset ownership and leverage, leaving anyone without appreciating assets constantly reacting instead of positioning. This is why education about money is so dangerous to the status quo, because if people truly understood cycles, leverage, and risk, behavior would change. Booms would slow earlier, and collapses would be smaller. But stability is bad for those who profit from volatility, which is why most education focuses on earning rather than preserving or positioning wealth. And why platforms like Global Economy Decoded exist to explain what's usually hidden behind complex language. When it comes to timing, many people ask whether we can predict the next collapse, and the honest answer is no, not precisely. But exact timing isn't necessary to understand direction, because collapses don't arrive like lightning, they build like pressure. And the longer debt grows faster than income, the closer the system moves to failure, especially as repeated central bank interventions make the structure more fragile. One of the biggest myths is that technology or policy has eliminated economic cycles, a belief repeated by every generation, from industrial efficiency in the 1920s to the internet in the 1990s, to today's faith in data algorithms and unlimited liquidity, while in reality, tools change, but human behavior doesn't, with greed stretching cycles longer, and fear ending them abruptly. Another myth is that collapses are purely negative because while they are devastating for unprepared individuals, for the system they serve a function by resetting valuations, clearing bad debt, and reorganizing ownership, which is why collapses are allowed to happen after periods of extreme excess, as stopping them entirely would require changing incentives rather than policies. Something those in power rarely do voluntarily. Awareness doesn't provide immunity, but clarity, allowing people to stop confusing price with value, stop assuming growth is permanent, become more patient and less emotional, and recognize that surviving cycles matters more than winning at peaks. This is where mindset becomes critical, because instead of asking how to get rich fast, the better question is how to avoid being wiped out. As those who survive collapses often outperform those who chase peaks by keeping liquidity, avoiding excessive leverage, and refusing to blindly follow hype, principles that may sound boring but are powerful in a system addicted to excitement. As we approach the end, the most important takeaway is that global economic collapses repeat not because leaders are incompetent, but because the system is optimized for short-term growth rather than long-term stability, where debt-driven expansion feels good until it doesn't, and when it breaks, the narrative resets, but the structure remains. The next time you hear that markets are unstoppable, risk is gone, or this time is different, pause and ask where the debt is coming from. Who benefits from continued optimism, and who will carry the cost when confidence fades? Because these questions alone put you ahead of the majority. If this breakdown helped you see the global economy more clearly, share your thoughts in the comments about what surprised you the most, and share this video with someone who still believes economic collapses are random accidents, because conversations like these spread awareness and prevent people from being caught off guard. Make sure you're subscribed to Global Economy Decoded, where we continue breaking down complex global systems into simple, honest explanations, because the goal isn't fear, it's understanding, and understanding is the first step toward navigating a system that was never designed to be fair, only functional. Economic collapses will happen again, not as pessimism, but as pattern recognition. And the real question is whether you'll see the cracks forming next time, or only notice them after the floor gives way.